welcome back, everybody, to the 4-Star Today's Market Explained podcast. This is our first episode for the year of 2023, so we're excited. We're glad to get 2022 over with. Chris, wouldn't you say?
Yeah. Welcome to be in the new year in 2023.
Yes. So anyway, folks, today we will do our normal regular review of where we stand and a preview of 2023. I'm Brian Kasal, founder and CEO of 4-Star, Eagle Scout, trustee of the National Boy Scout Foundation, advisor to CEOs and insiders, and chief dad to Quinn and Evan, and husband to the amazing Tripty. And with me again, of course, is our director of development, Mr. Christopher Reardon. Chris, welcome to the podcast.
Thanks, Brian. Glad to be here. Glad to talk a little bit about the markets to start off the new year.
And Chris is our master of all things portfolio reports, still loves his Cleveland Indians. He's a caretaker of the Golden Doodle puppy, and of course, a large and growing family over there, Chris. So congratulations on all that. Welcome to the podcast, and why don't we get started?
Sounds good.
Just remind everybody, if you like what you're hearing, please tell your friends, send them a copy of this, and then also give us a 5 out of 5 on the ranking. That helps our rankings and helps us get up there. We will start with markets, the economy, and then what we see out there. And we've talked for a number of years about the reach of the podcast. We're starting to reach a lot of areas, and we've been heard on 6 continents. But the 7th continent, Chris, is Antarctica, and we still have never been heard from anybody in Antarctica. But now we know a number of people this year that are going to Antarctica. So this will be the year, Chris, that we are heard on Antarctica.
Just got to hope you can get some cell signal or Wi-Fi down there.
That's right. So we'll see. So 2022 was a year to end. It was the worst year in the stock market since the very, very bad year in the Great Recession of 2008, with the markets being down dramatically. We'll cover that in just a minute on the details. But Chris, what does the positioning of the markets look like right now? What's in the lead? Well, what's relative strength positive today?
Yep. So coming into 2023 now, we have cash in the lead position still. So still a defensive market, that would indicate. But interestingly enough, we have international equities in the number 2 position, and it's gained 5 points since the last podcast. It's at 207 tally points. So, cash is at 235. Still a bit of a gap there, but, if that gap starts to close, that's something we would note as international equities potentially taking that number 1 position. And then in the 3 and 4 position, we actually have pretty much a tie. 3 officially is commodities, which did jump international or domestic equities, I should say. So it moved into that 3rd position. It's at 181 since the last podcast and equal. But the reason I say it's a tie for the most part is domestic equities, which is in the 4th position, is at 178. So really right there, they're pretty much neck and neck. I know it was -7 since the last podcast, so a little bit of a pullback in domestic equities. And then fixed income is in 5th, relatively muted. It was -1 at 159 since the last podcast. And currencies still in the 6th and last position. It gained 3 points and is at 131. So really, I would say the movement and news has really been in the top 4 positions. Fixed income and currencies have, for the most part, been relatively muted for 2022 and now to start 2023. But it'll be interesting to see what happens in 1 through 4 positioning moving forward and to start really 2023 now in the first quarter.
Well, it's interesting to see the changes, Chris. Cash is still number 1. That's a bear market. But international stocks have been out of favor for a long time, and those are starting to move up in position number 2. And then commodities had faded, and now they are rallying a little bit here, back up to position number 3. But U.S. stocks continue to fade. And we've had a really great run with U.S. stocks for a long time. But last year, 2022 is obviously terrible. And this year, looks like it, could be initially terrible, and then hopefully it rallies near the end of the year. At least that's the hope. Certainly, market's been very choppy here in the first couple of weeks of the year. Big up day, couple big down days. Yesterday was a down day. So we'll see where it goes. The interesting thing, though, Chris, is we're definitely in a bear market. And normally bonds are usually much higher ranked because bonds are usually a place where people go for safety. But because interest rates have spiked so so high and so quickly that fixed income had its worst year ever in 2022, and it's ranked number 5 and not looking like it's moving too fast anywhere too soon. What a shame. Although if folks do own bonds, bonds are generally lower volatility. I can't speak for last year, but if you hold on to individual bonds, the bond should mature, assuming there's no credit issues. So you should be fine. It's the holders of bond funds that might have a hard time if the fund is trading and moving those positions around a lot. Maybe the fund doesn't get all the way back up to what you paid for it, unfortunately, but certainly individual bonds would. So the fixed income areas, might be a place to look at now. Since rates are higher, you can capture a good yield. And if rates do go lower, which is what's predicted, once the recession is over, then you could have a gain in your bonds too. So bonds might be an attractive investment, even though they're ranked number 5 right now. The trends are negative, but they could turn positive. So interesting, Chris. So we'll see how this shakes out. We started the year in a very strange position. We're clearly not in a bull market. We're in a bear market. Maybe we're finishing the bear market. Maybe we're near the bottom. We don't know, but we'll certainly keep a watch on and keep everybody informed.
Yeah. I mean, I think it's definitely a little different kind of than the market we had coming into 2022. I believe domestic equities was still the number 1, and it was kind of still a booming market. We still had inflation kind of underlying, but it wasn't the headline that it reached kind of more in the spring when we had the early spring, I should say, and late winter when the Fed did start, saying they would raise interest rates. So, that kind of predicated the current market we're in, and what drove that is the high inflation numbers, things like that. So very different market from a year ago. We'll see it'll be interesting to see where we are in a year from now. But we are for certain in a bear market now. And we'll just have to see what the year gives.
So last year was a big down year, and there was huge tax loss selling at the end of the year. So any stock that was down a lot, and many of them were technology, experienced some severe selling in the last bit of December. Tesla, for example, which was the darling of everyone's stock portfolio up until last year, was down over 70%, 75% at one point. And there are lots of tax loss selling. Now we're starting to see some bounces in some of those technology names. We'll see if those bounces hold, whether they're just temporary and then they go lower. But we've seen a lot of carnage. The S&P 500 was down 19.4% for 2022. The Russell 1000 Value, which is the dividend stocks, down only 7.54. But the NASDAQ, which is tech-heavy NASDAQ index, was down 33.5%. And anyone who's had a technology portfolio would be down much, much more than that, because many people concentrated in tech because it was so good. But things do turn sour as they often do, and that's what happened to the technology. That's what happened in the other tech crash back in the 1999, 2000, 2001 period. Same thing, where it was the hottest thing, and all of a sudden it all totally collapsed. And then the Barclays Ag Index, which is the kind of the broadest based bond index, was down 13.01%. So, and there was a lot of bond categories that were down more than that. So not a great year for the bond market. They've never seen a double-digit down year for the bond market, by the way. So that was very, very difficult. And we obviously were in a mode of protection, Chris. So last year, we've had a number of portfolios that had our 4-star protection program. Our dynamic account was down about 1%. The U.S. sector portfolio was down about 11%. The growth and income moderate down about 3%. So we had a lot of protection built into those portfolios. And that's really all you can do in a bad market. Maybe you can trade inverses and do different things to try and make money in a bear market. But certainly the most important thing is to avoid loss. 85% of the time, the markets are going up, and usually you can make good money then. But when the market's in correction or outright panic, like it was last year, you want to try to avoid loss. And that's our objective, certainly, when we go through that. What else did you see in the market, Chris?
Yeah, I mean, I think that we saw a resurgence of commodities last year as well. Especially in the spring, it kind of muted out a little bit towards the end of the year, but we saw a major resurgence in commodities as scarcity, as countries were opening. We had kind of the first official summer with a lot of travel. You had a lot of people wanting to get out after a lot of these COVID lockdowns. So with that, we saw a resurgence of people traveling. So oil kind of spiked. We saw industrial metals, things like that. And it's funny, kind of at the tail end of it, we're seeing precious metals because now with you have interest rates rising. It's more of a currency market, if you will, going on now. So we're seeing precious metals play a little bit more of a role nowadays. So it's really been commodities front and center, I would say, in 2023. They still are playing a big role. And we see that a lot when we have international markets, even in the first, because as emerging markets, things like that, most people think of China when you think of emerging markets. If they're really, if their markets are really hot and they're moving forward, they're growing a lot, they're building a lot, they're utilizing a lot of commodities. So that could be reflected coming into 2023. We'll just have to kind of wait and see.
Well, in commodities, when they run hard and they run fast, but they're very, very volatile. So anybody who's investing in commodities needs to be careful while they're doing it. Our dynamic portfolio had a very good year because of the commodity market, but there are times when it bit back too. And the markets were really volatile in a month or so. We'd have a bad month and then it would come roaring back. So you have to be very, very careful when you're investing in commodities. And we had not had any commodities since as long as 2015, just for a short time. And then the last real good commodity year prior to 2022 was 2010. So quite a long time ago. So commodities are not something that most folks invest in. And also, if you're in commodities, be very careful because of the volatility. And if we're in commodities too long, that means it's bad for the economy, because if commodity prices keep going up, those are the input costs to lend to manufacturing and food and everything else. So commodities being good as an asset class for a long period of time isn't actually great for the markets. In the short run, it's fine, but you get more than a year or two, then we have a real problem in the economy for sure.
Yeah, it's a drag kind of on the markets.
Exactly. So last year was the worst market since 2008, when the S&P was down 38.5. And the good news, though, is, the market is usually going upward 85% of the time, as I mentioned. So the 15% of the time we went through part of it last year, maybe we're going through a little bit more. But the nice thing is that it's easy to forget when you're in this kind of position like we are right now. But bad markets are not perpetual. Bad markets will turn around. Everyone remembers the Great Recession, where the markets cratered badly and ended on March 9th, 2009 was the low. And eventually it started going up, and we had a very good decade after that. So this will not persist forever. So if you are able to invest and you have a long-term perspective, this might not be a bad time to be an investor, since the market prices are lower. So what do you say, Chris?
Yeah, I think that markets are cyclical. I think that that's something that people have kind of forgotten a little bit, because, we've been in this almost a bull market, really. When we've had bear markets, it's been for a quarter, very small, sharp bear markets that have corrected fairly quickly. So we've never really seen a drawn out bear market, and that's more the standard. So, I think it's important for people to keep in mind that markets are cyclical. It is healthy for a market to go into a bear market. It's kind of the natural order of things. So, we don't know how long the bear market will last, but it certainly will, go through its course, and hopefully in a year or two or less, we'll kind of be at the bottom and start that bull market back upwards.
Yes. Well, and one interesting aspect of what we've been through since interest rates are rising, at least now, all bonds in the world are at a positive yield. As folks might remember, many countries in Europe and Japan were at negative interest rates. The United States markets never went to negative interest rates, but as rates have been spiking upward, led by the Fed and the European Union, now rates are higher. So all bond yields are positive. The Bank of Japan was the last one to go above zero. So now even Japan, a country with some very difficult demographics, is now also at positive interest rates. So I've always said that's a good thing for savers. If interest rates would go a little bit higher, then savers wouldn't have to take as much risk in stocks and other asset classes to get a return. If you could buy an interest-bearing security and get at least some interest, now the The money markets are paying 4%. The 2-year treasuries are paying just above 4. So there's some opportunities there to get some interest, which is good.
Yeah, I mean, I think it's a renormalization, right? I mean, and that's important. We were during that the last, decade, almost 20 years, like for Japan specifically, 20 years, we've been kind of stuck in this zero interest, hyper growth environment. And they've been able to get away with that because we haven't seen inflation rear its head. And now we're seeing that, obviously inflation's not a good thing, but what it has caused is almost a renormalization on the market. For them to raise interest rates to kind of choke off a little bit of that monetary supply and bring in some of that inflation.
Well, and the Federal Reserve used to allow the economy to cycle around a little bit, recession, growth, back and forth. But then it became almost after the liquidity regimes and the quantitative easings of the 2008-2009 period, then it became almost like an elixir where the Fed didn't want to raise rates. They wanted to keep money cheap and keep the economy going. So as long as money is free and cheap, then the economy keeps going, and that's how they kept it going. But then you keep interest rates at zero for a long period of time. Eventually, you'll have to pay the piper. Eventually, that all breaks down, and that's what we've been seeing here in 2022. Eventually, they pay the price, and the Fed had to raise rates very, very sharply. So it's been a very difficult year. We've been in a recession basically all year, and we're now in 2022. Now we're facing, hopefully, not a terrible recession, but certainly a recession in 2023. Then the market will discount that in advance. Pardon me. The market will discount that in advance. And then eventually, hopefully, the market is bottomed right in the middle of that negative news and starts anticipating the recovery and starts going up. But certainly, it's been a very difficult time, and we're expecting a recession coming up.
Yeah, well, and I think that the key is you see this terminology thrown around as an earnings recession, and that's probably the next stage, if you will, of this. Is we're going to start getting earnings, I think, starting this week, and most likely those will start to tend to be a little worse, if not this quarter, next quarter, and so that will, I think, kind of start the next kind of stage. And then the markets are going to kind of renormalize from that. They're going to reprice in what those, earnings declines were. They'll set that base level and start to hopefully move up from there.
Yes. Well, now the Fed is still increasing interest rates, so we'll talk a little bit about that. The Fed is expected to increase interest rates here for the next couple of months and end in March. That's what the Fed has been saying. But Chris, isn't the market signaling that the interest rate increases are over?
Yeah. So where this is really seen as kind of in the U.S. dollar. So if they are seen as raising interest rates more, we're going to see a stronger dollar. If they think that they're done raising interest rates, usually we see the dollar start to weaken. So the U.S. dollar index actually touched a 7-month low earlier this week at 102.93, and that's versus kind of a basket of other currencies. So what we've seen more is speculators come out saying, if they're going to have to raise it all, it's going to be very, very small or not at all, from the dollar from interest rate standpoint. So it'll be really interesting to see how that plays out. And that has already caused this week, I know, some volatility in the market because when the Federal Reserve or any member of the Federal Reserve comes out and makes any comments, the market reads it as either hawkish or dovish. And then we see that volatility kind of filter through the markets on that day. So, if it tends to be a hawkish, maybe we'll see the markets go down. And hawkish would mean that they're going to potentially raise interest rates more aggressively than expected or more than expected. Whereas dovish would be that they're not going to raise interest rates more. It's going to be less than expected. So what that really plays is then the weakening dollar that would allow maybe more breathing room for other countries, things like that. So it'll be interesting. I'd say that's one of the unknowns coming into this year, what the Federal Reserve is going to do on that mark. And that's going to have a big impact, especially in the first quarter, I would say.
Well, and the Fed has been saying they're trying to engineer a soft landing, but the rate of their increases almost lead to, it's almost impossible to engineer a soft landing. And certainly the Fed increases are attempting to ward off inflation, which is their number one target right now, but it'll also, cause declines in the economy. We're seeing a lot of really difficult numbers in the economy right now. Chris, you had a number on jobless claims, right?
Yeah, and I would say, the labor market in the U.S. is in a really kind of interesting place because the jobless claims came out for the final week of 2022, and the jobless claims fell by 19,000 to a seasonally adjusted 204,000. So and people look at that and they say, all right, well, the job market is really strong. So the Federal Reserve has more room to raise rates. That's kind of what the read a lot of people get off of that. But on top of that, we're also seeing, especially in the tech sector, we've talked about this a little bit, is layoffs and monumental layoffs. Amazon came out and announced they're going to lay off nearly 18,000 employees, or 6% of their workforce. Coinbase actually this morning, I think, came out and said they're going to lay off 20% of their workforce. I know Salesforce is doing another large layoff. So it's this really interesting market where we still do have a tight labor market. And I don't think we're going to see like jobless rates skyrocket just because we still do have a tight labor market and just the way that the demographics skew. And on top of that, wages for workers who are staying in their jobs are up 5.5%. This was in November year over year, which is up from 3.7% year over year in January. So what we're seeing is companies are willing to pay for employees that are obviously saying that they're doing a great job, but we're also seeing a lot of unnecessary spending being cut, especially in tech companies, and we're seeing that kind of the initial salvo, if you will, of probably a jump to that jobless number.
Yes.
On top of that, U.S. small business confidence fell to 89.8 last month. That's the lowest since June, and that's also the 12th straight month the index was below the 49-year average of 98. So we still have businesses. Confidence-wise is still obviously historically low, I would say. Major concerns include inflation and the tight labor market, which are two major things we just highlighted. The U.S. trade deficit shrank in November, so imports declined 6.4% and exports were declined 2%. So both declined. I would say the biggest impact there was oil on the export front. Imports, the strong dollar had a major impact in just the pullback in consumer spending. Personal spending increased only 0.1% in November from October, so we're starting to see that slow down. We would expect to see that potentially slow down even a little bit more the next November to December number we see. And then the personal consumption expenditures price index rose 5.5% year over year in November, which was a slight cool off from a 6.1% year over year October number. So that's kind of a proxy, if you will, for inflation, or one of the reads people look at for inflation. So that would target that. We are seeing that inflation number start to creep down slowly, which is positive on that front.
That is good. Well, and U.S. imports are down 6.4%. U.S. exports are down 2% as well. So everything seems to be slowing down. And a lot of the positive numbers for 2022 were mostly positive in the first half and have been starting to turn negative in the second half. So trends negative across the board. One of the issues for the housing, the job market we've seen is that there are still many people that are not working. So they've done an analysis of the labor market. The labor force participation rate is lower than normal, than we would think would be in this time in an economic cycle. And part of the reason is that there's still many benefits coming through. So as we went through the COVID regime, many of the states, offered benefits, and some of them we were told we're supposed to get rid of the benefits, but didn't. So now the analysis has been there's over 7 million able-bodied males not working in America that they could be working. And a recent analysis of the combined benefits that is offered in various states, when you consider all federal and state benefits, the state benefits really changed the game a lot. The highest state is Washington State. A couple of two can get $127,000 a year to sit on the couch and be unemployed. Massachusetts is up there at 124. The lowest state was Montana at 54,000, which is still a big number. So if we continue to offer these kinds of unemployment benefits to folks, it's going to be hard to get our job markets completely, fully engaged like they should. I don't think the whole point of unemployment benefits was to keep people from working. They were to give you a bridge to another job while you're an able-bodied person. But some of the benefits have gotten perhaps a little carried away, and they're creating a disincentive for people to work. So those 7 million folks that are sitting at home and working, getting benefits, they're incented to do that because they're getting a good paycheck. So if you're comfortable living on 127,000, you could go to the state of Washington and get some really nice benefits, right? But that's certainly going to hurt long term. So anyway, and then we also saw the Philly Fed came out recently, and they identified that the household survey and the Bureau of Labor Statistics job numbers are diverging, and they've been diverging since last spring. And there's almost a million job gap between the two. And so the Bureau of Labor Statistics is coming directly from the government, where the household survey is not. So it turns out now that the Bureau of Labor Statistics numbers are wrong, and they're starting to admit that. Now the question is, why were they wrong? Was it because it was an election year? Was somebody spiking the number? And we don't know. But there's all kinds of speculation as to why those numbers are so far off. Because usually they'll be off a little bit, a month or two, and then they'll converge back and they get back in line. But this year it didn't happen. So certainly, you can kind of speculate as to why the number is wrong, but clearly it has been wrong. And then you mentioned the tech layoffs, Chris. They're everywhere, right?
Yeah. Yeah, I mean, it's, more and more, and we're seeing each week, I would say, new tech companies, announcing the layoffs. And, there's speculation. I mean, as far as a lot of the CEOs came out and said they overestimated what growth would be, which I'm sure plays into it. But, I think a lot of them also leverage these tech layoffs to just, let go low performers. People in the companies that, they hire quickly, they hire a mass amount of people, and then, when they have to lay off this amount, they cut the low performers and trim the fat, if you will. So it'll be interesting, but I know in some companies, tech companies especially, we're seeing a second round potentially of even layoffs. So it seems to just be kind of consistently driving itself forward.
So that's also filtering into spending, of course. Personal consumption was down 6%. So people are spending less. And the kind of the most striking thing I saw was car sales are down 8% for the year of 2022. Now, we all remember in the summer of 2020 and then coming into 2021, people couldn't even find a car. They didn't have cars on the lots. You'd have to pay over sticker price. I remember going to lease a vehicle, and they had one vehicle that I could pick instead of dozens and dozens like they normally do. So now car sales are down in 2022, and certain companies took it particularly bad. Nissan was down 25%. Honda was down 33%, which is really terrible. General Motors showed a big increase, though, however, or at least a small increase. And they overtook, as you mentioned, Chris, they overtook Toyota again as the largest car seller. The zero financing deals are gone, and the average payment for a car is over $700 a month. And the average interest rate is over 6%. So those zero interest rate deals are gone. Now, inflation and raw materials were causing lots of problems, but now all those numbers are starting to mitigate as we come into the recession period. We're also seeing an increase in chip inventories, and anyone who's following along, cars are really computers these days. So a lot of computer chips and other things, electronics in a car. So all those chip inventories are going up, so that should also ease pricing. So.
Yep. Yeah. I mean, I think it'll be, we're going to have obviously higher car payments for interest rates, I guess, on the car payments, but most likely, and I think it's the positive aspect of it is we're seeing that decluttering of the supply chain for the auto manufacturers. So most likely they'll be able to drop those car prices down significantly. So we'll just see lower priced cars, higher interest rates on them, and similar to probably what we're going to see in the housing market, just kind of a comeback to normal, if you will, from these astronomical prices a couple of years ago for used cars and even new cars.
Yes. Well, and we've seen now that various states are having different experiences with population changes where people are leaving states with high taxes. Some people are calling it political blue and red states, but it's really much more about policy. I remember a meeting I was in a year ago with Senator Rick Scott, who is the former governor of Florida. And, Senator Scott talked about how when he became governor of Florida, that they had as many problems as some of the blue states now, like Illinois and California. Debt was high, taxes were high, and they had to make some changes. And once they turned it around, now you see the current governor, Ron DeSantis, continuing that growth. And now Florida is an amazing growth miracle. So any of the states that are experiencing, high taxes, high regulation, seeing population leaving, that's what people do, they could turn around with proper policy. So we're hoping that going forward that we get better leaders that come up with better policies for the states, so the states don't keep losing population. They talk about, again, blue states, red states and all that. It's really more high tax to low tax. And if there's correlation to political party, then so be it. But it's really much more about policy than it is about politics, really. And then also kind of examining whether demand side economics or supply side economics can solve some of the issues. Demand side, it's really hard to tell what's going to happen when we initiate demand side activity, but we certainly can control the supply side. So if we control the supply, then it's easier to manage the economy better. So, Chris, what do we see out there for next year? You said GM took over Toyota as number one.
Yep. Yeah. So, GM retook the title of America's top car seller, and that was last year. Toyota, for the first time ever, actually jumped GM as the best-selling American car seller, which was the first time that we had a non-American car manufacturer as the best seller, which was kind of interesting. But coming into Q1, though, Bed Bath & Beyond is exploring bankruptcy. So many of you probably know the popular retailer Bed Bath & Beyond. They've been struggling very mightily. In Q3, their sales are expected to fall by nearly a third. And they're looking at potentially filing for bankruptcy kind of coming into Q1. So Tesla coming into towards the end of 2022 had trouble delivering cars. Their December deliveries dropped by 20% from a year earlier. This came as China decided to end its more than a decade-long subsidy for electric vehicles. So China ended their subsidy, and with that, their cars got more expensive. And so they've had trouble delivering and getting orders there. I would say on the flip side of that, from what I've seen coming into 2023, they've been able to lower prices to get rid of the inventory. So we've seen major lines in demand as prices have lowered for Tesla. Towards the end of 2022 for the holiday season, Southwest had a major meltdown. They canceled over 16,700 flights from December 21st to December 31st, or the holiday season really. And that wiped out its anticipated fourth quarter profit. So they're in a lot of hot water. A lot of people are not happy. I know personally, my sister, they were supposed to go to San Diego and then Disneyland over the holiday season, and they got stuck in Denver, Colorado. Were unable to make it to Disneyland, so they lost a lot of money on that. So I know they're not alone. There's a lot of travelers that had major issues. So Southwest is, I know, rolling out several compensation packages, things like that. It'll be interesting in Q1 to see what they do. Towards the end, on the Ukraine front, Putin called for a 36-hour ceasefire over the Orthodox Christmas. Ukraine spurned that offer. They just said, they didn't see that as in good faith, especially with everything going on. In Brazil, everyone kind of coins the phrase banana republic. Well, really saw that on full force as about more than 1,500 supporters of the former president, Bolsonaro, you can say it, were detained for participating in the riots that targeted Congress, the Royal Palace there, and other government buildings. So they had a storming due to their perception that the elections were rigged. Probably potentially right. Like I said, that usually goes side and side with the banana republic, and Brazil is known for corruption. But so we have kind of a lot of uproar there, a lot of volatility. And then the final thing I will note is coming into 2023, Chinese citizens are now flocking to renew their passports as China has dropped several of their border controls put in place during COVID to help kind of keep the virus contained and out of China. So it'll be interesting. And I think talking about supply and demand with that, what will if we're going to see a large amount of Chinese citizens traveling coming into 2023, that could, provide a big boon for the global economy as far as spending, as far as potentially oil prices, if we're seeing more flights, things like that. So, there's a lot of interesting things coming in 2023.
It really is. So then the dollar's hit a 7-month low as well.
Yeah. So the U.S. dollar index touched a 7-month low of 102.93 earlier this week. So, that's positive, and most of that is off of speculation that the Fed will not be raising interest rates more, will be more moderate in their interest rate rises if they do any at all. But that's been really mixed. I know Jamie Dimon, the JP Morgan Chase CEO, came out and said that he thinks that's misguided, that they're going to have to raise interest rates more, closer to the 6% mark. Which is much more aggressive than what the market's pricing in. So what the Federal Reserve decides to do will play a large part in, and not only that, the dollar strength, but also how the markets do, and especially in the first quarter. It's going to be volatile as people speculate and as the actual numbers come out.
Well, so last year also, kind of a troubling trend. We saw a tax return of an individual citizen released by a federal congressional committee. Now, it's a precedent that it's never happened before in America, and Congress, I think, probably crossed the line here. That individual happened to be the previous president, President Trump. Now, there's politics involved in this, of course. Most presidential candidates release their tax returns, but they're not required to, and President Trump didn't. And of course, there's been people for years trying to go after President Trump and try to defeat him in the election, and they were successful. But now, releasing tax returns, the group that did it might come to regret it, because then the new Congress might turn around and start releasing their tax returns. So this is really not a good sign. Supreme Court, however, looked at it and said that Congress can decide if there's a legislative need, which was their excuse. So the Supreme Court did not intervene and say you can't release them. So Congress can actually do that. But what a not a very good trend for liberty and for privacy, for sure. And there's been a lot of talk about political courts and everything, and we're seeing people who like certain rulings but don't like others, and so they bash the court when the court does something they don't like, and then they say the court's good when they do. But the court's really not there to be partisan or take someone's view. They're there to execute the Constitution and interpret the Constitution, and that's what they're there to do. So, it'd be good if we could all kind of get back to remembering that's what it's all about. For 2023, we expect, Chris, to see a lot more climate change politics. Now, interestingly enough, our friend Jeff Carter from Points and Figures, and you can get on his blog on Substack, pointed out that the whole cryptocurrency world can go bust. We've seen this whole situation with Sam Bankman-Fried and FTX, but most of it has been private money. So it doesn't have a lot of effect on government, doesn't have a lot of effect on taxes. It's certainly like a Madoff scandal, for example, is just another big, huge scandal, and a lot of people are going to lose a lot of money, but it doesn't really affect government. Climate change, however, is all government money, because they use government to go after, different issues in the climate change world. And the irony of the whole thing is that the major oil companies are the largest developers of alternative energy, but they barely get noticed because their base is fossil fuel, and they're trying to get rid of fossil fuel. At least there's a crowd that are trying to do that. Now, we've seen what happens when we go too fast. In Europe, we're seeing just incredible prices for energy. Fortunately, Europe is having a bit of a mild winter right now so far. Let's hope it stays that way. But there's going to be large numbers of people living in shelters and in high schools overnight because they can't afford their energy. We've also seen this in the state of Hawaii. Hawaii went so far at electric energy and alternative forms of energy that they do not have enough energy out there, and the prices are going up to service their people. So we moved perhaps too fast, and so prices are going up. Everybody wants clean energy. Everybody wants to keep the environment safe and sound. So that might lead us to change from fossil fuels, but the rate of doing it is really the issue. And so I think we figured out how to do it wrong. We figured out how to go too fast. So we'll see a lot more about climate change this year, Chris.
Yeah, no, I mean, I think that the hydrogen story too could play a major impact. It still has a ways to go.
Yes.
Or hydrogen and fusion, I should say. The fusion, I think, is the bigger one. But fusion, that fusion reaction that we talked about, I believe on the last podcast, that's a great example of a sustainable energy source that could be a huge driver of clean energy moving forward. And if that turns out to be true, I don't think anyone's against clean energy. I think everyone's for clean energy, but we just need it in a realistic time frame and to have an actual plan.
Yes, the continuing energy generated by that experiment, if they're able to make that as a commercial enterprise, it's cheaper, it's cleaner. It would solve a lot of the other issues, and this whole debate over all these different types of energy could be solved right there just by that one issue. So that's a really exciting development. Also, this first week of the year, as we start the week of the year, we see Congress finally decided on Kevin McCarthy as the speaker. Now, in I think over 100 years, we've never had a situation where it took more than one vote. Everyone knew who was going to be the speaker, and the whole party came alongside. But the majority was thin, and so the Republicans had some battles, and it was actually a healthy process. It took 15 votes, but they finally got Kevin McCarthy in as speaker. And then their first bill was to repeal the 87,000 IRS agents that the previous Congress had voted in because they felt it was basically to attack the people. And so most people have been honest about their taxes. And certainly if you're not, you'll get a letter from the federal government because they can track everything now. They're very, very good at it. But that was their first thing. And, I think it'll be a healthy thing that all the procedural things that were taken away by previous Congress. Now bills have to be on the floor for 72 hours. People get to read the bill before they actually vote for it. So they're creating a lot of new rules to get the House back to the way it used to be run, which is very, very healthy. So we're looking forward to great things from the new Congress. And so a lot of exciting things for the year, Chris. Hopefully the recession isn't too bad. And maybe the recession bottoms here soon. The markets will bottom. If they aren't already now, hopefully they'll bottom soon. And then we go off to a good year and rebuild our economy. Yeah.
I mean, I think hopefully there's 2023, we're hopeful will be a better year than 2022 for the markets. But, we'll just see. I think it'll be a volatile first half at least. But hopefully, like you said, Brian, we start to see some positive, more positive, I should say, outcomes towards the tail end. Exactly.
Well, and that's all we have for the stated comments. I just want to remind everybody, the 4-Star Wealth site, there are a number of blog sites. So a number of our advisors are always blogging with interesting ideas on investing in different subjects. In the leadership matrix, we had a number of posts here recently. We had one about shooting for the moon and reaching for the stars in 2023. And we have a couple of other really interesting things coming out. So watch the blog posting on the 4-Star website. We also had some podcast interviews that were quite interesting. Michael Friedman of Lighthouse Life discussed life settlements as an investment category. And I thought that was very interesting. So folks might enjoy that. And then also Michael Kading, the CEO of Norhart, which is a real estate developer up in Minneapolis, talked about a new real estate development model that has lower costs, much lower costs than the traditional general and subcontractor model. And so he believes that that'll help them sustain themselves through a real estate downturn. And guess what? We're going into a real estate downturn. So we're going to see whether that model works or not. But you can hear Michael Kading talk about it as you listen to that interview. So I think that's all we have today, Chris.
Yeah, sounds good.
Well, great. Well, for the whole 4-Star team, which is Laura, Chris, Christine, Fred, Jack, Kamal, and Jonathan in Chicago, and our East Coast team, Tucker, Karen, and Brian. Thanks everybody for being with us on the 4-Star podcast and today's Market Explained. We'll be back with another episode very, very soon. Welcome to 2023. We're going to Antarctica, and we're looking forward to a great year.